Hi everyone, Donna here with Bookkeeping Made Simple. Today I want to go over the three main financial reports that you are going to see and that you are going to need to understand your business. And of course, before we get started, as always, if you enjoy these videos, please like, share, and subscribe. Hit the red notification bell on YouTube so you get notified when new videos are uploaded. And with that, I'm going to dive right in. Now, I will be uploading videos explaining these reports in depth. This is a quick overview so that you can understand how these three reports are going to help you understand your business. We'll go into them really in depth real soon, but this is the broad picture. And of course, I understand for a lot of people, if you're not in the accounting world, it may be about as interesting as watching paint dry. But this is about your money. And so it's something that a lot of people struggle with understanding. And I always laugh. I kind of say, I spent years in school to understand these reports. So I don't think less of anyone if they don't. I mean, this is where I live. It's my wheelhouse. And I have clients that put millions of dollars to their business every year that never look at them. That's a bad idea. But with that, I'm going to dive right in. The first one we're going to talk about is the profit and loss or income statement. This is the one everybody loves to talk about. This is also where the term the bottom line comes into place. So the income statement shows your revenue, the money that's flowing into your business, and your expenses. Now, if you'll remember yesterday, I talked about the difference between accrual accounting and cash accounting. We're going to only talk about accrual accounting today. So all of these are going to be accrual statements. In other words, we are looking for, not all of your revenue. Your revenue will be recognized when it's earned, not necessarily when you receive it. You may receive it early, you may receive it later after you've invoiced, but this is the revenue that's been recognized as earned income for your business. And it could have just one line that says sales. It could have multiple lines. We're going to talk about that next week as well. And then it's going to list out, the next section is cost of goods sold, by the way. So we have total revenue, and then we have cost of goods sold. So cost of goods is going to, and we call it COGS, by the way. And I need to slow down talking. I try to make sure that I kind of speak to the lowest common denominator, which sounds horrible. And I know that. But my assumption is, because I throw a word out there and I know what it is because I've been doing this for years, it doesn't mean that my viewers have any idea what I'm talking about. So I am going to define some terms as we go. If you already know what these terms mean, please understand that not everybody does. And so I want to make sure everybody can understand them. Cost of goods sold is also referred to as COGS quite a bit. And this is, okay, I'm going to get a little bit more in depth than I wanted. So we have cost of goods sold. When you are a manufacturer, you also are going to have work in progress. The cost of goods sold is the cost. Let's say you just buy inventory. It's going to be what it costs you to buy your inventory and have it shipped to your location. And there may be some other things that go into it, but this is what it costs you to create the inventory that you're selling. Well, what if you have a service-based business? A lot of times this also includes things like merchant account fees that are just part of the cost of doing business, not an expense, but a cost of doing business. And there's always a few questions about certain things, whether it should be under cost of goods or whether it should be under profit and loss. In a lot of ways, it is a judgment call. If you have inventory, we might have to do what's called landed COGS, which means that we need to know how much it costs to ship each unit and add that to your cost of goods sold. So your gross profit, top line, we're still at the very top of the income statement. Your gross profit is your revenues minus your cost of goods sold. Okay, we'll go into cost of goods sold in a later video. The next section, and this is going to leave you your gross profit. So if you are selling cars and you buy a car for $3,000 and you sell it for $10,000, you're going to have revenue of $10,000 and cost of goods sold of $3,000. And that's going to leave you with $7,000 in gross profit. Okay. So now we have the expense section. The expenses are the things that you have to spend to keep a business going. So this is going to include office staff, office supplies. It's going to include your vehicle expenses. If you're a salesperson and you have to physically go out and visit with clients, your travel expenses, your vehicle expenses would be included here. Telephone expense, meals and entertainment. Now, I'm going to talk about this later too, and I've really got to write all this down. Meals and entertainment is a special kind of category. You can write off some of your meals, but not all, but you cannot write off entertainment. I'll explain that in another video. In fact, I'm going to write that down right now before I forget. We're going to talk about reports, COGS, M&E. Okay. So I want to make sure that, that's all really clear. We'll dive into that into a later video. So that's all basically the expenses that it costs you just to be in business are going to go into your expense section. Once you've taken your gross revenues less your cost of goods sold, which leaves you with your gross profit, and then you take out your expenses, payroll, all of that stuff. At the very bottom, the bottom line is going to show you whether you made money or lost money. Were your expenses higher than your revenues? That's what we need to know on the income statement. But it doesn't give you a complete or full picture of your business. It gives you a partial picture. The next report that we want to talk about is the balance sheet. I have a few clients that don't understand why the balance sheet is important, so I kind of wanted to go over that. Like I said, we will go into this in depth. It'll have its own video a little bit later. But just as the overall thing, the balance sheet has three major sections. There is a formula in accounting that explains the balance sheet, which is that your equity or your ownership share is equal to your assets minus your liabilities. Now, an asset is cash and cash equivalents or anything you can sell for cash. Okay, so if you, for example, if you extend a loan to another business and expect to get paid on that, any money you're expecting to come in off of that is an asset. So if I lend money to my boyfriend's business, I am going to, for those of you who are wondering, it's still Christopher, don't worry. If I lend money to a friend's business, if I lend money to another business, I'm expecting to get paid. It's an asset to me, but it's a liability to them because they have to pay that back. So your assets are going to be your checking account, your savings account, your funds you have put aside for specific projects. It's not going to include things like your personal retirement account unless that is owned by the business. It is going to include cash equivalents. It's going to include money market funds. It's going to include investments that you've made in other businesses. So we have different sections in the asset section. First one's cash and cash equivalents that are highly liquid. You can get money out of pretty quickly. And then we have current assets, which we would expect to be able to sell those in 12 months or less. Current always means 12 months or less. And then we have fixed assets. And fixed assets are things like buildings, land, vehicles, equipment, inventory. Inventory is a current asset. The reason inventory is a current asset is we expect that to turn over multiple times in a year. That kind of thing. So we then take, and inventory is valued in a number of different ways. Three specifically I can think of. Inventory is either accounted for as first in, first out. So when I'm valuing inventory, I know we can see what you actually paid for things. But when we are figuring out the inventory calculations, we need to know what the replacement value of that is. So first in, first out. So if I buy Diet Cokes from Coca-Cola and I buy them at last year's prices, let's say I buy them at pre-2020 prices and I'm only paying $2 for a 24 pack. But today they cost $7 for a 24 pack, or for, excuse me, $2 for a 12 pack. Today that same 12 pack costs $7.25 at my local Walmart. So I could, first in, first out means the things that I've sold now, I'm going to value in my inventory at their replacement cost. If you're wondering why prices, by the way, if you're wondering why gas prices go skyrocketing or drop very quickly, it's a very volatile market. It is because when you're paying for fuel at the pump, you have to pay the replacement cost of that fuel. First in, first out, or FIFO, is the preferred method to account for inventory. And if you think about it, if you're in the food industry, if you're a restaurateur, for example, or you're using my Diet Coke example, you want to get rid of your old inventory first. So we value your old inventory at the old prices and your new inventory at the new prices. So it is first in, first out. So then when I'm doing cost of goods, I have to know, okay, how long has this been here? How much inventory of Diet Coke do we have at 2020 prices for $2 a 12 pack? And then I can figure out, this was my least favorite part of my bachelor's degree, was dealing with inventory. There are methods to help figure that out, but what it's called is first in, first out. I will go into inventory in a later video. The second method of valuing inventory is called last in, first out. So first in, first out, you are basically valuing the inventory for what you bought it for. To be very, 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 very general. Like I said, I will go into depth into this later. The other method is last in, first out. Now, companies like last in, first out because they can value inventory higher and they can show a better, they don't have to pay as much in taxes. We'll talk about that later. And the third way is specific identification. So let's say you're a jeweler and you have been honored to bring in a specific diamond. Trying to think of one that everybody knows, the Hope Diamond. Let's be honest, the Smithsonian's never giving that up. But if you have something extremely valuable like that, or if you are building, if you're Rolls-Royce, you're going to use specific identification. So all of the parts for that Rolls-Royce is going to go to that Rolls-Royce. Okay. You can think of it as if you're a custom home builder, if you're building a $5 million home, then we're going to actually specifically identify all of the inventory and costs of that home with that home. This is not an assembly line thing. First in, first out, FIFO, and last in, first out, LIFO, are designed for more of an assembly line production. But specific identification means it goes specifically to one item. And that's usually very high ticket items, as you can tell. So again, if you're building a $5 million custom home, then you're going to have all of the costs and inventory to go along with that home specifically identified with that home. We don't have to do it inventory way, or excuse me, we don't have to value it as if it was on a production line because it's not. It's going to be specifically identified with that one project. Job costing is also going to typically be identified most easily with specific identification methods of inventory. So now you have a $5 million custom home, and that is in your inventory. And that's where it stays until you sell it. Again, we're not talking about assembly line thing. We're not talking about home builders that come in and build 30 homes at a pop. We're talking about a very custom home. And so it doesn't matter. What matters is you have that $5 million home in inventory, and everything's going to be specifically identified with that. Again, I will go into that later, I promise. I have the memory of a mayfly, and I apologize for that. So inventory is going to show up there. And like I said, we're going to go into that a bit further. So all of your assets are going to add up to some number. And let's say, just for easy math, we're going to call it $1 million. You have $1 million in inventory. Could be more, could be less, depends on your business and how old your business is and what you're doing. But let's say you have $1 million in assets in your checking account, your savings account, your payroll account, your accounts receivable go there. The inventory you have on stock, all of this is in your assets. The next section is liabilities. Now, a liability is actually the opposite of an asset. A liability is a debt that you owe. So I talked yesterday a little bit about expenses and accrual accounting and how some of your expenses are going to come in as a bill that you're going to pay later. If they do, we want to go ahead and put them in, because now that's an account payable. So this is things such as trade lines. In other words, if you open a credit account with Home Depot and you're a home builder, that is your trade line. If you go to Truck Pros and you have a line of credit with them, that's called a trade line. That is specific to your suppliers. So you could have trade lines there. Those are usually due in 30 days. So that's going to be a current liability. You could have bills that come in, such as your phone bill, your internet bill, utility payments. Those can come in, and you may or may not pay them in the period in which you were billed. So we do want to apply those to accounts payable. The next section is your current liabilities. These are all the things that you expect to pay in the next in the next 12 months. So what does that mean? Well, that means if you have a mortgage on your office building, what we want to do is we want to move the current portion of that mortgage to current liabilities. And it will show up on your balance sheet as something like mortgage on this address, current portion. The reason we do that is, and we don't do this with everybody, the reason we do that is so that an outside party who needs to review those can then run the numbers, such as an underwriter for a loan, can then review those and see how much you expect to have to pay out in the next 12 months and how much is a long-term liability. Let's say you have just purchased a vehicle and you spent, how much did I spend on my car? About $30,000. I know I'm going to make 12 payments of about $500 a piece on those. So I'm going to put that amount or $6,000 in my current liability section. Notice I haven't mentioned interest yet. Now, someone else viewing my balance sheet can see that I have a note on my car and 6,000 of it I expect to pay over the next 12 months. So there's a number of ratios we can run to show how solvent your business is. We're not going to cover that today, but we are going to cover it. And one of those, we need to know what the current, how much you can afford to pay over the next 12 months. So that's your current assets. Then you have your long-term, liabilities. I'm talking about liability. So my car note that I'm paying over the next 12 months is the current section of my car note. The rest of my car loan stays in long-term liabilities. I expect to have to pay that over 5 years. I only need to move the first years to my current liability section. It also lets me see how quickly I'm paying that down. I mentioned interest. That actually is an expense, and it will show up on your profit and loss. Not in your liability registers. It shows up in your profit and loss. It is an expense. It is part of the cost of doing business. If you want capital for your business or you want to use other people's money, you have to pay for that. Okay, so we covered your assets, your liabilities, and the third section is equity. Equity is the part that we like. And it can be a little bit complicated because there's several different ways of referring to equity or accounting for equity. So again, the equity you have in your business is your assets minus your liabilities. Equity is actually pretty fluid. So if you take out more liabilities, it's going to reduce the equity that you have in your business. If you get rid of some of your assets, that's also going to reduce your equity. Excuse me. So what we want to do then is we want to take a look at the different sections of the equity section. One line is going to say opening balance equity. And I've had a lot of people ask me what that is. When we start a set of books for an existing business that already has credit card accounts, liability accounts, checking accounts that are already open, but we're maybe starting the books from scratch, or we are beginning books for an existing business and there's already money in those accounts, we might not want to go back 25 years to find the beginning balance. We may have to start where we are. So when that happens, we will debit the asset or the bank account and credit opening balance equity. Now, of course, if they're a liability, it's going to be the other way around. But what we're showing is that there was a balance before we started doing the books. And we need to account for that somewhere. Accounting is always a double entry. So if you put cash in your bank account, you have to explain to us where that cash came from. Did it come from your account? Did it come from your sales? Is it from previous years? Do you not know where it came from? So we either need to put that in as an owner's investment, or if we cannot identify it, it will go to opening balance equity. Now we have retained earnings. Before I talk about retained earnings, I'm going to talk about net income. On your income statement, you will see a line for net income. That's the bottom line. It could be a loss. And that is basically what's left over after you subtract all of your expenses from your revenue. That should carry forward onto your balance sheet for the current period. If it doesn't match your profit and loss, if that line on your balance sheet doesn't match your profit and loss, then there's probably a problem with the date. So if you run your balance sheet for August 1st to September 8th, and you're looking at a profit and loss that's only August, it ends on August 31st, you're going to have a mismatch. So you need to make sure your dates are correct. But assuming that your dates are correct, and let's say you're just looking at August, you're looking at August's profit and loss, and it shows $150,000 in net income. When you pull up your balance sheet for August 31st, it should also show $150,000 in net income. One of the interesting things about the balance sheet is the income statement, the profit and loss, is over time. So it's going to be over a specified period of time. It's usually over a month, it could be over a quarter or a year. And at the end of that period, those amounts reset. On the balance sheet, it's a snapshot. It is like, click, click, this is where you are right this second. So I always kind of chuckle at QuickBooks because they will put in a date range. What it actually is the ending date of the balance sheet is the date of the balance sheet. So if you're running one for August 31st, it's going to show these are the balances of August 31st. It doesn't matter what you put down as the beginning date. We're only looking at the ending date. Just an interesting quirk. Okay, so I hate it when I lose my train of thought. It really makes things difficult. So your net income is actually going to carry over from your profit and loss. Now, if you've been in business more than a year, you're also going to have retained earnings. Retained earnings So let's say you have started your business in 2022. It is now 2023. We are looking at the balance sheet as of August 31st, and we are looking at the profit and loss for the period ending August 31st, for the month of August. So we're going to look and we want to see, does this net income match the net income over here? If not, it's probably a date issue. And on the balance sheet under retained earnings, it's going to show the net income of 2022. So the previous period or the previous year. That is a cumulative balance. So if you have net income of $100,000 a year, and you've been in business for 5 years and your income has been pretty consistent, your retained earnings should be right around $500,000, because that's what it would be over 5 years. Or it'd be $400,000 plus your net income of $100,000. Keep in mind, those retained earnings are cumulative. Now we have the section that most people are very confused about, but it is important, and that is owner's equity. Now, I have talked about, and we'll talk about again, the different types of business structures that you can set up. And that is going to affect how owner's equity is treated on the balance sheet a little bit. If you are a sole proprietor or a single member LLC, you are going to see two accounts inside of QuickBooks that QuickBooks automatically creates. One is owner's pay and personal expenses. It may also be called owner's draw. That is the money you have pulled out to pay your own expenses. So let's say I need to pay my rent. So I'm transferring money out of my business into my personal account so I can pay my rent. Well, that's going to come under owner's pay and personal expenses or owner's draw. We're going to see that. On the other hand, we also have an account called owner's equity. So let's say I pay my rent, but then I decide I want to put the money back. If I do that, then that owner's pay and personal expenses and owner's equity should add up to 0. So your owner's equity is your investment in the business, or if you're paying back loans to the business, it should show up there. There's other ways of accounting for that, but we're not going to cover that in this video. And the money that you took out of the business. And it's perfectly okay for you to take money out of your business if you need it. If you have a partnership, depending on who your partner is, typically, if it's a married couple, we will treat it as if it's a sole proprietor. If it is not a married couple, if it's just like a couple of friends, for example, when I very first started having a bookkeeping business, I was working with a man who's now my brother-in-law. And so to properly do the books, we would have Donna's draws, Donna's equity, and Michael's draws and Michael's equity, because we were not married, we're just friends, and he would take money out and I would take money out, and we wanted to make sure that that was applied to the correct partner. It's a very common thing. We want to make sure that we know which partner took money out and which partner took money in, because that is going to affect your taxes. So that's the only difference there. We would need to, if you have more than one person, more than one partner in the business, or more than one owner, we need to know which owner is taking money out so that we can account for it properly, or putting it in. We need to know that too. If you have a corporation, whether it's an S Corp or a C Corp, now you're looking at an entirely different thing. You're going to see shareholders' distributions and paid in capital. So it's either, and it could be a stock purchase. Most of my corporations are C Corp. I don't think I have any, most of my corporations are S Corps. So they're very small businesses. I don't think I have any C corporations that I do books for. So we're just going to talk about S Corps. When that happens, now we're going to be posting that money to a specific person but it's going to kind of show as a vendor. So I'm gonna open it up. I'm gonna look at my vendors. I'm gonna say, oh, look, John has given us $100,000 to put into the business. Well, that's going to show up in either, we'll call it additional paid-in capital. It's going to show up as an investment in the business. And there's a number of different ways of naming that. That's usually common stock. It could be preferred stock. It could be additional paid-in capital, but we need to account for it and we need to tie it to the person that made the investment. If that person then takes money out, we are going to show it as a shareholder dividend. Now, I may have accountants making mad, angry comments on my video because I'm keeping this very, very simple. I'm assuming this is a 1 or 2 person business. But let's say you have an S Corp and it is maxed out. You have 100 people paying in. And they need to have a distribution. So now, instead of just paying it out like you would for a partnership or a single owner, now you need to declare a dividend if you're going to. And there's a lot of different rules about that. But if you declare a dividend, now we have to figure out how many shares were in the business. So if you put in $100,000, what was the value of those shares when you purchased them? And how much is your earnings per share of the business? And that becomes very complicated. So we're not going to cover that in this one. I'm going to keep it really strictly to, if it's a 1 or 2 owner business, we're going to call it shareholder dividends, but it is a draw. There's a number of ways to account for it. But if you see that on your balance sheet, that's a little bit more complicated of a situation. So what that tells you is, if your assets are high and your liabilities are low, you're going to have more equity in the business. One of the problems we run into as well is that a lot of business owners do not like to put liabilities on their balance sheet. They don't want us to know about them. The problem with that is we're going to find out. I always laugh at people. They try to hide things from their attorney, their doctor, and their accountant. And those are the 3 people you never want to hide anything from. Okay. And that is because, and you never want to make them mad. That's because they can do the most damage to you if they chose. But they need to know everything about you to be able to be effective. I often say being an accountant is very similar to being a doctor in that I've seen it all. And I have seen the worst books ever. And I promise you, they're probably not yours. And people get really embarrassed about it. Just like there's certain things that doctors see that people get really embarrassed about, and just watch Tales of the ER, you know. There's things that happen in the emergency room that doctors see that are embarrassing. There are things that happen that attorneys see that are embarrassing, but they still need to know. Even if you sit down, if you have a criminal defense attorney, if you sit down with him and say, yes, I did it, he still is required to give you the best defense you can afford. You're entitled to that. If you go to the doctor and you are having really weird symptoms, you can't disguise them. You can't hide them from the doctor because that could be a life-threatening illness. The same thing with your accountant. We need to know. We need to know everything about your money, about your business. And that includes all of your loans, all of your assets, all of your credit cards. And then we can help you determine what actually rightfully belongs on the books. We are going to err on the side of having more of it because that's going to help you understand your business a little bit better. With that said, we're going to move on. The statement of cash flows is the final one, and a lot of people don't ever see that. They never look, they don't know where to find it. In QuickBooks, it is under the main section, and it's the very last one, kind of forgotten at the very end of the column. I will show you where to find it later. This tells you what money came in, what money went out. The profit and loss does not show that because your liability payments only show in the statement of cash flows. They do not show on the profit and loss because they are not considered expenses. So your statement of cash flows has 3 sections. The first one is cash flows from operations. Let's say you don't have any credit cards. You are running everything on cash only. You don't have anything financed. You don't have any investments. All of your cash flow is going to come through operations now. So this means this is the money that came in, your net income. This is the money that came in. You had no liabilities. You had no investors you needed to pay. You had no investors that put money in. That it's just straight from operations. The first thing it's going to show is how much cash did you have at the beginning of the period. And for illustration purposes and for easy math, we're going to say you started with $1,000. It's in your checking account. You're not doing anything with it, but you're going to start making some money. And let's say that you have a friend that invested $100,000 in your business. Well, now you have $101,000 from somewhere. It's going to show up as that's going to show up as cash flow from investment. Well, let's say you needed a little bit more money, so you took out a loan to cover some operating expenses, which I don't recommend, for $100,000. Well, now you have $200,000 and $1,000. But some of that money went out. So we're going to say you had to pay back your investor $5,000. Well, we're going to take that out, and it's going to show in the specific section. And it should show what cash you started with, what came in from operations, what went out from operations, what came in from finance, what went out from finance, and what came in from investing and what came out from investing. And at the bottom, it should show how much you should have in your bank accounts. What cash do you have available to spend? It might be a negative number. If it is a negative number, that usually means that you're badly over leveraged, that you have taken out way too many loans, you have not been very careful with your money, and that is something we need to fix, because you can't spend too many months with a negative cash flow. We have seen this in big businesses. WeWork was a cash burner. Uber was a cash burner. I mean, they were burning through, they had massive negative cash flows. That means they were spending more money than they were bringing in. And a lot of, sometimes that is just kind of required, but for the kind of clients that I have, I do not want to see a negative cash flow. They are not on the stock exchange. They are not publicly traded. They do not have a lot of investors. That usually means that they are taking out too many loans and have too many payments, and they cannot keep track of it all. They're over leveraged, as we say. Now, and I kind of think of it as the statement of cash flows as the kind of budgeting I used to do back in the day when I was a brand new mom, a brand new wife, brand new mom, and I was learning how to do all this for myself, which would be, I would take the back of an envelope and I would figure out, okay, I have $500 in the bank and my paycheck is going to be $1,000. And out of that, I have to pay for this and this and this and this and this, and this is what I have left. So let's say I have $1,500 after my paycheck and what I already had, and I have rent that's due, and I needed to buy clothes, I need to buy diapers for my baby, I needed to make some utility payments and insurance payment. I'm going to list all that on the back of my envelope, and whatever's left over, that's what I have left over to spend until the next payday. Statement of cash flows works very much the same. It's just a little bit more in depth about talking about where the money comes from. Because if you are a W-2 employee, the money only comes from your paycheck. But if you're a business owner, you might have investors, you might have financing, you're probably going to have some debt, you're going to have some credit cards. And we need to be able to see where this money's coming from so that we can make plans later to make sure that your cash flow remains positive. And that's the big three. That's it. It's a pretty simple thing. Sort of. We're going to go over each one of these reports in depth very soon, and I'm looking forward to explaining those to you next week. You guys have a great weekend, and I will talk to you again soon.